Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we'll be discussing covered call ETFs. So these are solutions that are for clients who need that monthly cash flow from their portfolios, looking to enhance that level of yield in their portfolio. And we'll get into why these strategies are gaining in popularity recently. What are the benefits and considerations that you should look at when looking at all the different options out there? And exciting news, we'll also be introducing two new BMO covered calls that we launched this week. So this isn't going to be an ETF covered call ETF 101 video. Just wanted to get that out here. If you do want that, we have a video on Market Insights you can watch, and Adrian also has a video that will show you that you can watch on 101. Just as a reminder, today we're not providing any advice or investment recommendations. Today's episode, like all of our episodes, is about providing education around investing and around using ETFs for Canadian do-it-yourself investors. So with me today, I have Om from our Covered Call ETF Portfolio Management Desk. So welcome back, Om. Nice to have you here. I'm also joined by Adrian Starinieri. So you might recognize Adrian from his YouTube channel, which is called Passive Income Investing. And on his channel, he creates content that's really focused around yield-enhancing strategies like covered call ETFs. And he talks about, which I love, his own personal investment portfolio and his experiences as part of this FIRE movement, which for those of you who don't know, that stands for Financial Independence, Retire Early. So Adrian's actually joining us from Panama right now, where he moved close to a year ago now. So Adrian, welcome. I'm looking forward to having you share your story with our channel.
Yep, thanks, Erin. Good to be back.
All right, and before we get started, a quick reminder to check out our YouTube channel. You can watch any episodes that you may have missed in the past. And as always, please remember, if you haven't already, to subscribe and ring that bell so you get notifications. So for today's 1-minute update, I've just included a quick snapshot here on sector performance. So this is showing the S&P 500 for US equities and the TSX Composite for Canadian equities. And they're sorted here by weekly performance. So highlighting here in Canada, relatively positive week overall, and you can see in that first column. And you can also see that infotech and healthcare have been the top performers this year so far, so over the past month, just a short period. But it's quite different from their performance over the past year. They were the biggest losers over that experience or that period. So I think that's kind of interesting to look at. And then US, in contrast, on a year-to-date basis, we see communications, consumer discretionaries, materials among the top leaders. So it's always interesting to keep an eye on who are those top performing sectors. And again, a bit of a shift here, especially with communications that were hit so hard over the past year with names like Meta and Alphabet and Netflix, those type of things. So seeing a bit of a, I don't want to say turnaround because it's only been a month, but definitely a bit of a rally in some of those names. All right, so Adrian, welcome back again to Market Insights channel. It's not your first rodeo. You have joined us as a host in the past on Fall into ETFs and Spring into ETFs, but it's good to have you here as a guest. We've also worked together, as I'm showing on the slide here, on a number of educational videos on Adrian's channel. So I mentioned the covered call ETF video. It's a really good one-on-one video. So I'd encourage everybody to sort of start there if you're not familiar with how they work. But Adrian, I'd love to kick things off by having you just tell us a bit about your story or your investment journey and how you began using covered call ETFs.
Sure, I'll try to keep it brief. I don't want to bore you to death. So my wife and I started investing on our own about 2012, but really for fun, focusing most of our disposable income on actually paying down our mortgage at that time. So we have no financial background whatsoever. We both work in the tech field. So at that time when we first started, when we were doing it just for fun. We do what most people do when they first start, right? They stock pick individual companies, but that became very stressful, very time consuming, because you're at the mercy at at the stock price level, right? So we eventually switched the dividend stocks because we really fell in love with the idea of passive income, right? It's tangible cash coming in like our salary. But the issue with dividend stocks is that the really high yield ones, or the higher yield ones, tend to be smaller to medium-sized companies, and like we learned the hard way, can cut or reduce their dividends at any time. So our new mission became to figure out how to get high yield, 7% plus annually, but being invested in quality, blue chip stocks. So the hunt for yield was on, because as we know now, especially what's happening now in 2022 and 2023, no job is safe, right? We're hearing about all these layoffs happening. So we also experienced some pretty close calls in 2008 and 2009 in the tech industry. So that's when I really started discovering what is my portfolio's bread and butter, I would say, funds that use covered call strategy. So that's when I started investing in them, in covered call ETFs, closed-end funds. And of course, since BMO is the biggest provider in Canada by far of covered call ETFs, they immediately came up on my radar, right? So these funds have really high yields, but they hold quality companies. So your income stream is fairly safe and consistent. And the best part is really that the fund managers take care of writing the call options. So the income is completely passive. So in 2018, when our mortgage was actually paid off, that's when we really started testing the waters with this style of investing, and we quickly reached about $1,000 a month in passive income. And long story short, after crunching the numbers, we figured that if we sell off our condo and invest it all in these types of investments, we could basically live for free off the passive income from our portfolio. So that's exactly what we did. We sold our condo in November 2019, and the following month we were financially free in our mid-30s. So my wife quit her job that same month. I continued working at Air Canada a little longer, but I too eventually quit in September of 2021 to really focus exclusively on our YouTube channel, which is all about our income-focused strategy, which obviously continues to evolve over time as we gain more and more experience, but also as more and more income-oriented products, like I'm sure we'll discuss later, come out. And let me tell you, 2022 and even 2023 is looking to be a really blockbuster year for new covered call products. So I can't say I'm the first one ever to invest in covered call ETFs, but probably one of the first ones to really go all in with this strategy, become financially free because of it, and create a YouTube channel where we share our journey and knowledge with the world. So not only do we show our entire portfolio from A to Z every single month, but we also talk about our favorite funds, interview fund managers, discuss various income investing topics. So the main goal is really to educate people about this style of investing so they too could reach financial freedom and start living their best life. So I'm actually still, very surprised how big the channel became and the positive influence it's had on people's lives. We always get messages, emails, and have even met several people in person who retired early, or their lives have been advanced because of the strategy or the extra passive income, right? So yeah, that's pretty much it.
That's great.
So,
Thanks, Adrian. Yeah, I think like you said, the growth of your channel is a great indication of just how many investors are really recognizing the benefits of these ETFs. So yeah, thanks for sharing your story on that front. There are a lot of ETF providers out there, more coming to market every day, it seems, with new covered call ETFs. So we've put this chart together that just shows the overall market share across the different ETF providers. You can see BMO is about 64% of the overall market share, but there's a lot of new entrants coming that are growing fast. And I know that you're very knowledgeable in the different options out there. So I thought it would be good to have you outline for us some of the different flavors, if you will, because everybody sort of does it different, and what some of the considerations or trade-offs might be from the different options.
Yeah, there's a lot of options in Canada. I kind of have an OCD, so I got to know all of them by heart. So I pretty know most of them by heart. So when it comes to the landscape, when it comes to covered call ETFs, Erin, as you know, the two major factors when it comes to the covered call strategy is the portfolio coverage and the option moneyness, right? So the portfolio coverage is on how much of the portfolio are they actually writing covered calls on, and then there's the option moneyness. So there's more aggressive at the money calls, which generates more income but gives up all the upside of the stock price. Or then there's more moderate out of the money calls, which gives you less income but lets you participate in the growth, right? If stock prices rise during that time. So some ETF providers take a systematic approach, or I kind of call it, a set in stone approach. Others take a dynamic approach. So BMO, and like the chart shows, the biggest provider, I consider more the classic or the vanilla option. They take a systematic approach where the coverage is about 50% and the options are sold out of the money. So it's a really good balance between both income, getting that extra yield, but also growth as well. There's CI that also has a systematic approach, but they write they do coverage on 25% of the portfolio, but they write at the money options. So more aggressive options, less portfolio coverage. But most providers, the other ones like Harvest, Horizons, Brompton, Evolve, they use a dynamic approach. So nothing is really set in stone, but they typically never exceed about a third of the portfolio in terms of coverage. But how aggressive the calls are really depends on the market conditions. So on top of that, there's also a newer type of strategy out there, leveraged covered call ETF. So Harvest is pretty popular for those. They have 6 of them. So these ETFs use modest leverage, typically 25%, to boost the yield, the growth potential of the ETF, but it also increases volatility by 25% as well. And finally, there's what I like to call the all-in-one covered call ETFs, which is basically an ETF that holds multiple covered call ETFs and also uses modest leverage. So this structure automatically increases your diversification and can streamline your portfolio, since you won't need as many ETFs to be, or covered call ETFs to be diversified. So there's currently 4 of these on the Canadian market. The first one came out in 2021. That would be HDIV. Managed by Hamilton ETFs, but Harvest and Brompton have ones as well. So that's pretty much the landscape.
That's great. Thanks for that, Adrian. That's a good overview. And then lastly, I know you mentioned some of the benefits in terms of why you use them, but maybe you can give us just an overview in terms of, in a nutshell, what are the benefits of these covered call ETFs?
Sure, the benefits are great. I love these benefits. So some benefits are really the same as a regular dividend ETF, I would say, because there's still, ETFs that hold a portfolio of stocks. Let's not forget. So consistent passive income, typically on a monthly basis. It's an ETF, so it's hands off. It's professionally managed. There's quality investments in there, good quality underlying stocks. No need to stock pick on your own, and there's since there's a lot of stocks, you have diversification. So pretty typical benefits, very similar to a dividend ETF. But where the covered call ETFs shine, or the benefits, is that there's lower volatility. That's what those covered calls do. So volatility, I guess you could consider that lower risk. It's a perfect strategy, or a perfect ETF to really buy and hold forever. So someone who's living off the interest or living off the income. So they're great for people who need an income supplement, right? Like retirees or people who are trying to build an income stream to achieve financial independence or financial freedom. AKA you're basically living off of your investment passive income, right? So that's kind of hard to do with 3 to 4% yield, but 7% plus, it becomes much more feasible. All of a sudden, you don't need millions of dollars to achieve financial freedom. There's also the situation or the benefit that you're avoiding the drawdown conundrum that many growth investors have, or people who are in mutual funds, for example, that don't give out income, right? It's a huge worry and concern for them because they always think, do I have enough money? Will it last me? Will my nest egg last me for the rest of my life? Will I have enough to leave my kids? So I can't think of a more conservative investing strategy than never touching the capital, only living off the interest or dividends. So another one is tax efficient distributions. Well, this is because the income that's generated by selling call options it's not considered interest income. It's considered capital gains income, which is literally taxed 50% better than interest or regular income. There's also a good benefit. You could potentially outperform the market in general during the bad times, right? So when markets are doing good, which is most of the time, everything is great. When markets take a big hit, that's when your nerves could really be tested. And covered call ETFs typically do well in a down or flat market because volatility means richer options premium. So your income stream remains intact no matter what the market does, no matter what the market conditions are. So this is a huge mental health benefit, something that I discuss on my channel, but it's rarely mentioned in the investing world. It's all about returns, but I find it quite odd considering that money investing could be a huge stress for most people. So those are the benefits in a nutshell, Erin.
For sure. I like your point about sort of that psychology of having that monthly distribution too. I think a lot of investors can benefit from that.
Yeah.
All right. Thanks, Adrian. Now, we do see a lot of new ETF providers coming into the covered call space. So I just wanted to stress here that I think one of the most important things to highlight is that experience matters. And I really can't say it enough. These are not strategies that are simple to execute. And with experience comes really the ability to find cost efficiencies. Better relationships with trading desks means better execution, cost efficiencies. And with experience comes knowledge, right? Knowledge of how these options can react across different market conditions and what's the best way in any particular market condition to achieve your goal. So at BMO, just highlighting, we do have a very experienced team here. You can see across the desk huge numbers in terms of experience. They've managed these products through different market cycles, basically since we began with them. So Chris McCaney, Chris Heeks, Charles, and of course we have Om here. So thanks for joining us, Om.
Thanks, Erin.
Hoping to bring you into the conversation now so that you can walk us through your job as a covered call ETF manager and talk to us about how BMO really, I don't know, Adrian mentioned this, really tries to balance that consistent income with, the potentially to maximize that potential capital growth as well.
Yeah, for sure. So yeah, as Adrian mentioned, right, it's very important to have that monthly income, but at the same time, clients are looking for that upside participation, for their long-term or medium-term or long-term growth goals. So at BMO, what we believe is having a strong foundation. So the way we start off any of our covered call portfolios is making sure the companies or the stocks that we hold within these portfolios are blue chip, dividend paying or dividend growing companies, with stable balance sheets. And on that we do the covered call or strategy on those companies. So in terms of the options that we write or pick, right, as Adrian here mentioned, yeah, 50% of our portfolio is usually covered. So we write call options on 50% of our portfolio. The other 50% of the portfolio has full upside participation. And what we further do is on the 50% that we are writing call options, we use out of the money options. And how much out of the money really depends on the company. So there are other competitors that take a plain vanilla approach where they write at the money, or they say 2.5% out of the money and they write it across all names. What we do is a bit more dynamic approach where we look at the company, we see, we take volatility into account. And based on that, we are able to write slightly more out of the money or slightly less. So give you an example, if you look at Canadian banks, very, they're stable banks, grade A banks within the world. Their volatility tends to be lower compared to some names such as, if you go to the other extreme, you look at technology, right? So if you look at Netflix, Google, their volatility tends to be much higher. So if we are writing covered call options on some of our technology names, we tend to be a bit more out of the money because we have that ability to still collect that higher premium, but at the same time allow our clients to participate on the upside. So the table here kind of just shows, depending on the implied volatility in the market, how much out of the moneyness you can go and how much premium you can collect. So as you can see on the implied volatility table, so on the x-axis, if the implied volatility is high, let's say 20%, 25%, we can go 5%, 6% out of the money. But as implied volatility is lower within, let's say, Canadian banks, it's about 10 to 15%, you tend to be a bit less out of the money, but we still are out of the money to have that upside participation. And in terms of timing, we tend to be between 1 to 3 months, and this allows this allows us to diversify our strike, so we don't have a pin risk. So what that means is, if concentrating all our options on one day, you could have a market event risk. So if Feds come out with the inflation, or if there's inflation data, or Feds come out and say, come out hawkish or dovish. So we don't want to have a market risk just for one day, because next day, markets react the other way and markets start coming down. So based on that, we diversify our options across different strikes and different time periods to give that income but growth benefit as well. So if you go to the next slide, I can go into a bit more detail on the payoff structure. So if you look at the blue line, that is kind of the traditional payoff structure that we see in the covered call space, where you collect a bit more premium upfront, but you are giving up that growth potential. So that's the blue line. So you can see after a certain point, you're not participating on any of the upside. However, if you look at the way BMO does, which is 50% covered call, using out of the moneyness and having different time where the options expire, we can see, yes, over the medium to long term, that strategy pays off as the stock price rises. We are still participating on the upside, and we have that higher upside potential. So from not just from an income, but also from a total return perspective, we are doing a better job using this kind of methodology. Moving to the next slide, I can go in a bit more detail on, as Adrian went over, the different kind of structures that are out in the covered call market. So there's the BMO approach, which is what we do, 50% and out of the money. There's some at the money options, and depending on the coverage, 25 or 33%. So you always like to say, covered call strategy, it's not meant to be a strategy where you are looking for 100% upside, right? There's a chance that you won't get that full 100% upside, because you have to balance that growth and income. And that's our main focus, that balance. So if you look at the red line, which is kind of our systematic, 50% out of the money approach, you can see that, if the stock price is at 60 and it goes up to 60, 62 and a half, we do much better than other strategies that are writing at the money, because we have that income plus we get that growth potential. Of course, if the stock price rallies, let's say 10% in a month, right? Yeah, the strategy it's not meant for it to capture that full 10%. So it might lag that benchmark by a bit. But again, these strategies are meant for stable blue chip dividend companies that tend to go up in a steady, slow fashion on a monthly basis. So having a thoughtful approach in being able to balance income and growth is very important in these strategies. And as Erin, you mentioned a few slides back, this is where experience comes into play. We are the #1 covered call strategy provider in Canada. I think we launched our first in 2011 with the covered call banks, and after that we have just launched different covered call ETFs within different sectors and markets. And it shows, right? It's a relationship business as well with the brokers, because in the Canadian market space, the option market is not as big as in the US. So we have to be careful when we are doing options to take into account liquidity, getting that, working out pricing. So we have those relationships with brokers that other, competitors might not, given how much of a footprint we have in this space.
Perfect. Thank you for that overview, Om. And you alluded to it, but we did launch 2 new products this week. So I'm showing on the slide here the complete suite of our covered call ETFs. This is available on our ETF roadmap that you can download on our website. It's a nice snapshot of all of our offerings and the tickers available to you. So we do have sort of those dividend or core focused covered call ETFs in Canada, US, Europe, and global. And then we have more of a sector or satellite approach, which is that bottom level there. So Om, walk us through our 2 new exposures and why we launched them.
Yeah, for sure. So we have 2 new covered call ETFs. One's on the healthcare, so ZWHC. And then the second one is energy, which is ZWEN. So let's start off with healthcare. We launched the healthcare ETF because it provides Canadians a new exposure that they didn't have, and healthcare sector tends to be a bit more defensive. We did see that in 2022, that it is a much more defensive healthcare sector. However, we have seen that the yield within the healthcare companies is not as high. So this does provide clients to get that defensive exposure, but at the same time do not sacrifice on yield. And healthcare, if we look kind of medium to long term, we are in a population which is aging, so healthcare services will be on the rise. So these companies will tend to be able to capture that, grow their revenue, grow their revenue and their profit margins based on that. So it's a great exposure for clients who want to have healthcare defensive exposure with the income tilt to it. Second one is energy. Energy we launched because we already have an energy product on the equal weight energy ETF ZEO. On the income basis, we saw a need that we could provide given the higher volatility within the energy names. So we saw that we were able to provide a much higher income by capturing that higher volatility in these energy names. And the way it's structured is it's 60 in terms of exposure, country exposure, 60% US, 20% Canada, and a few international exposures. So again, it's a great product, and we believe in the energy story. Given recently we saw China come out with opening, getting rid of the COVID restrictions. So we have seen there's a huge pent-up demand for travel. Given this week is the the new year back in China, and this week is I think a vacation for everyone. It's a holiday week, so there's a lot of travel. So there is a pent-up demand there. But there are still some headwinds within the oil market. We saw that in 2020, where oil prices went from $80, from $60 to $120 and back to 80. So there is still volatility in that market. So that's why we believe this is a great product for clients who want to get that exposure, but want to do it in a much more risk-controlled manner, and at the same time collect some income on an ongoing basis. So it's So those are the two products we launched recently.
Thanks for that, Adrian. I know you're going to hit us with the question in terms of why we don't have an all-in-one covered call ETF.
Yeah, that's a very big question. I constantly get, with all the all-in-one coming out, why doesn't BMO have one? So yeah, for sure.
Well, you made a good point. We've got all the pieces now, so it should be coming. I'll advocate for that. All of the new ETFs that we launched, same fee, 65 basis points, comes in all in MER somewhere around 0.71. But can you talk to us a bit more about fees? I think there's some things that we need to be clear about, some considerations to remember when it comes to what we see when we look on a covered call ETF provider's website when it comes to fees.
For sure. So the fees that you see here is just the management fees, which is 65 basis points, and there's other fees that are on top. So for example, trading costs, all those fees get embedded into the ETF. So I always recommend clients to look at the fact sheet for ETFs. In the fact sheet, you get the total cost that the investor is actually paying. So to give you an example, there are a lot of fund-of-fund solutions out there in the covered call space, and what we have noticed, what happens is within these they hold other ETFs within the fund-of-fund space, and you get charged not only on the underlying holding, but you also get charged on top at the top level. So you're not just paying one level fee, you're paying two level. So what happens is when you look at the total fee paid or the total MER, which is management expense ratio, the total one, it's anywhere from 1% plus to 2%. It can go as high as 2%, right? And I know we might talk about it a bit more, but if you start incorporating leverage, there's cost of borrowing now. If you had asked me in 2019, hey, what's your thoughts on leverage and cost of borrowing, I would have said, hey, it's not bad. Cost of borrowing is very, very cheap. It's reasonable. It's very. But now the cost of borrowing has gone very high. We saw that in the last 8 months, 10 months, where Bank of Canada increased interest rates so quickly. So cost of borrowing also is a big factor that investors should take into account, because at the end of the day, it comes out of their total return. So yield might be very lucrative, but if they look at their total return, it's not as lucrative, because it has to come out of either their price return or their dividend. So, those are a few things, I always recommend clients or investors to always keep an eye out on. On top, management fee, great, but also look at the total cost that is usually listed in the fact sheet.
Yeah, sometimes we say the management fee is just marketing, right? It's on the website, it's what you see first. Unfortunately, you do have to look at that ETF fact sheet. Not everybody's double dipping on fees and fund of funds, and not,
Exactly.
Sometimes the leverage isn't that much, but just make sure that you're aware of it and that you're looking, because that ETF fact sheet won't lie.
Yeah, exactly.
It's not marketing, is what I'm trying to say.
If I could add a couple of things on that, Erin. So I always tell people, look at the MER instead of the management fee. That's where you'll see the total expense typically. The second thing, and this is just a question I keep getting over and over again, so this is perfect to have you on here, and I could talk to you about it. So the management fee, or the MER, a lot of people think, it'll come out of their dividend. They'll see it come out of their account. So people need to remember that the MER, that is, the dividends or the distributions, and the performance, aka the total return that they see on BMO's website or another ETFs. But that's all net of fees, correct? It's fees. It's not something you'll see being taken out of your monthly dividend, out of your account. This is, the way I like to describe it is it's included in the fund, and performance and distributions are net of fees. If you could just confirm that. A lot of people get confused with that.
Yeah, that's correct. And you make a good point. If that ETF is performing, if it does have a 1.5% fee, maybe you're not too concerned. But of course, it is net on the website, so you can have a look at that. But always want to make sure you're getting that all-in fee.
Exactly. It's whatever is listed on the BMO website is always net. So if it shows 8% net return, so that includes all the fees and deductions, what might be. So
yeah. All right, great. And just to cap off here, I wanted to highlight a couple resources before we wrap up. Number one is our etfmarketinsights.com website. We on this website have a blog that we've been committed to posting about every other week, and I'm highlighting this because Om actually wrote our latest one, and it's on covered call ETFs. So if you haven't looked at it yet, this is a good spot to start. And then I also wanted to highlight a report that we post on our ETF Market Insights website, which I'm showing a snapshot of here. It's much longer and more in depth if you look at it on the website, but it's under the enhanced income section. And what it does is it breaks down each of our tickers, each of our portfolios in terms of a bunch of different metrics. So what is the percentage of the portfolio that's covered? We mentioned it's typically around 50%, so you'll see the consistency there. It also includes the percentage out of the money that the options are written, and the term, and the allocation across the different terms, so you can see how active the strategy is within our sort of set of rules. It also shows the breakdown between dividend yield and the yield generated from the option premiums. So again, this is just a nod to the level of transparency that we provide at BMO in terms of our process. I think it's really important that if you are investing in a product like this, that you can see and understand exactly how the portfolio managers are executing it. So if you want to do a deeper dive into BMO's lineup, check out that report on our website. All right, so we do have two audience questions today to get to. So the first one is, what BMO ETF would give me exposure to energy? So I can take that one, and Om, you mentioned it. ZEO is our BMO equal weight oil and gas ETF. As it says in the name, it's equal weight. So what's the benefit of that? It really helps reduce concentration in those bigger energy giants here in Canada that we know so well. So I think it provides much better diversification across the sector, and that's why we went with the equal weight version. So ZEO has been quite popular. I've been getting a lot of questions on it right now, and over the past year as energy has really taken off. And Om, this is a good one for you. Why doesn't BMO have a leveraged ETF?
Yeah, that's a great question, and I think I talked slightly about it. One was on the cost of leverage. So in terms of, covered call ETFs. So what does it mean to take leverage? It's usually what's happening is you're going out, in the market, you're borrowing some cash. So, sometimes they have 25% leverage or, 50% leverage, depending on whatever the strategy is. And since you're borrowing cash, you're paying interest rate on it, cost of leverage. So that's the cost of leverage. And since you're borrowing cash to implement in a covered call strategy, what's happening is your upside and downside returns are asymmetric. So what do I mean by that? Since it's a covered call strategy, you're writing call options. If you're writing call options, you're capping your upside. Since you're capping your upside on a leveraged basis, the upside potential is getting capped because you're writing covered calls even on that 25%. But on the downside, you don't have that much protection because if markets start coming down significantly or at a very quick rate, you participate 1-to-1 on it. So it's an asymmetric return on the upside versus downside. And I always say, if you want to take leverage, you want to have asymmetric returns on the upside, right? You want to have less downside when markets come down, and you want to have more upside when markets go up. So that's one of the reasons, I think we are still looking into it, but that's one of the reasons we haven't really launched or we don't have a covered call ETF, because again, this comes down to what do we want to provide our clients. We want to have a good balance between growth and income. And with the leverage covered call, a lot of investors don't see that asymmetric return where you're giving up some of that upside and you increasing your downside. So you're increasing your risk, but not 1-to-1 ratio on the upside. And second, again, as I've mentioned, the cost of borrowing has increased significantly. So it comes back, when you're borrowing money, it comes again out of your yield or from that total return. So it's not as beneficial as many people think. And thirdly, if during like market volatility, when markets get very volatile, you could have a bad client experience using leverage, as you can have when markets go down 10-15%. You participate on that, but as markets rally, you have some covered calls written on it. You don't get that full upside participation as you had intended.
Yeah, not everybody.
There are a few risks in the leveraged covered call strategy. So, that's why we currently don't offer one. But again, I think it's, again, balancing that risk and reward for the end client.
Okay, good thoughts there. Thank you, Om. All right, so that caps off another great week of ETF Market Insights. Thank you, Adrian, for joining us today. It was great to have you on, and thanks, Om, for coming on again. Next week, we'll be back, same place, same time, with our 2023 ETF Outlook episode. So we do this annually, and it coincides with a big report that we put out that you can find on the website as well, that goes over all of the trends that we see coming into 2023 and the outlook for this year. So I'll be joined by Mark Reyes, our head of product for BMO ETFs. So I hope you can join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.